In the early 1970s, many households across the United States experienced a shift in the way money behaved. Prices that had once felt stable began rising steadily, sometimes quietly, sometimes dramatically, and families who had previously relied on predictable budgets suddenly found that the same income no longer stretched as far as it once did. At first, the changes seemed temporary, a short disturbance in an otherwise stable economic environment. Yet over time, it became clear that something deeper was happening inside the monetary system. Inflation during that era did not simply change prices, it altered financial psychology. For decades before that period, many people had grown accustomed to a relatively stable relationship between income, savings, and purchasing power. Money held in savings accounts tended to preserve its value reasonably well, and long-term financial planning often assumed that today's dollar would behave similarly tomorrow. When inflation accelerated, that assumption began to break apart. Economists often describe inflation as the gradual erosion of purchasing power, but its psychological effects can be just as significant as its mathematical ones. When individuals notice prices rising faster than expected, their behavior often shifts in subtle ways. Some begin spending more quickly, believing that money will buy less in the future. Others attempt to protect their savings by moving capital into assets that historically perform better during inflationary environments. Mathematically, the mechanism is straightforward, even if its consequences are complex. If prices rise consistently each year, the real value of stored money slowly declines. A savings balance may appear unchanged on paper, yet the quantity of goods and services that balance can purchase gradually shrinks. Over long periods of time, this process can reshape the way people think about saving, investing, and consumption. The 1970s illustrate how financial systems respond when inflation becomes persistent. Businesses adjust prices, wages gradually respond, and financial markets attempt to incorporate expectations about future purchasing power. Entire industries begin adapting to the new environment, and financial tools evolve to help individuals manage the changing landscape. From a behavioral perspective, one of the most important lessons from that period is how expectations influence decision-making. When people begin expecting inflation, they adjust their financial behavior accordingly, which can reinforce the very economic dynamics they are reacting to. Spending patterns change, saving strategies shift, and investment preferences evolve. Looking back, the inflation era of the 1970s serves less as a warning and more as a demonstration of how economic systems influence human behavior. Money is not only a numerical measure, it is also a psychological signal that guides how individuals plan for the future. When that signal changes, financial habits often change alongside it. Understanding this historical moment provides a useful lens for interpreting modern financial environments. While every economic period is unique, the relationship between inflation, expectations, and human behavior remains remarkably consistent. By examining how people responded in the past, it becomes easier to understand the structural forces that continue shaping financial decisions today.